So what we did was at 5.1, we looked at how do we maintain and sustain resources, and how do we effectively utilize them from an organizational context. And then at a later stage, we expanded unit 4.1 organization to something called people management. So that means what are the different types of people which work within the organization, what are their roles and responsibilities, job descriptions. But in the level 5 unit, we studied how do we manage people. When you're in supervisory role, what managerial styles work, what leadership styles work. And then we looked at something called managing communication. So at level 4, we studied different types of communication techniques, verbal, non-verbal, written, oral, different types of communication that role within, the organization or a business. But at level 5, we studied how do we look at different types of communication, the structure of the organization, and how does the culture of the organization kind of shape the different forms of communication. So it could be lateral, upwards, downwards, things like that. And then an add-on unit that we studied respect to HR, or managing people as a resource, was personal and development. So that means we looked at how do you look at trainings, self-managed learning in an organization, what is the role of training and development. And then we also reviewed the process of how organizations put their employees through some sort of training, and when they put them through some sort of training, how they keep track of the training and development, so that at some stage they have employees which are moving up in the organization, or at least they are progressing from a point of view of being effective and productive, and they are able to help reach the organization meet the objectives or goals which are set across the year. So now what we are looking at doing is, once we've understood that, we are looking at now understanding how the businesses which we know from an organizational context work within an international setting or an international environment. So when we looked at business environment in unit 4.1, we studied various factors like micro factors, which are internal factors which affect the business, external factors which are macro factors, and then we also looked at the types of businesses, which is in terms of the ownership type. And here we then looked at very basics of frameworks that could be applied in the case of businesses working within the context of economic within the context of economy. How do they get affected by government policies, competition, fiscal monetary policy, some of the instruments that we looked at. And we also partly looked at what are the organizations which kind of influence or affect business and trading from an international perspective. So organizations like WTO, World Trade Organizations. We looked at some of the bits and pieces within the European Union, and what are the effects of those on internationalization of business. So if you're an organization which has businesses in the UK or office within the UK, and then you operate globally, what could be the effect of such regulation when you have to comply with them across geographies? Now, this understanding in particular, when we look at Unit 4.1, is going to be extrapolated into understanding business operations from a global perspective. So if you look at an organization, lots of UK organizations, when you look at Tesco's, Marks and Spencer, organizations which are essentially British, but they have over the years expanded, globally to look at, operations in different countries. So when such organizations expand globally and operate globally in the context of having businesses in different geographies, different countries, how do these organizations cope with managing, operations from that aspect of globalization is what we're going to study in this unit. So organizations like Primark, you look at Next, H&M, you look at, Tesco, Marks and Spencer, you look at Burberry. All these organizations are essentially British, but at some stage, I can't take an example of ASDA because it was a British organization, but is now part of Walmart Group. So some part of the aspect in terms of law and legislation actually within the organization follows through from the US because it's owned by Walmart. I'm not taking an example of Aldi or Lidl because they're German organizations essentially, but operating within the UK. So we could study both aspects, but the idea would be to try and pick one organization up, which is truly a British organization, how it's gone global, what are the remits of their operation in different countries, what kind of activities they do, how do they, kind of measure or look at evaluating their activities when they, kind of sell products and services across different countries, and then what are the technologies they use within the organization to kind of maintain efficient, maintain efficiency in terms of operations, but also in terms of, processes and policies. And that's the remit of this particular unit. So the idea here is to understand the workings of a business from a global perspective, issues faced, solutions, what they make, what they do in terms of reaching to solutions, and then what are the factors which actually affect those businesses working in different geographies. Is that okay? Now, in terms of the first learning outcome, I think this directly correlates to what we have already done in business environment, which is ownership of, or different types of ownership of the organization. So when we look at, learning outcome 1, which says understand the key differences between global business operations, here are some of the tasks, things like analyze key differences between organizations working in different sectors, industries, and contexts, is basically looking at, the ownership structures and in bit of, business environment they work in. So, for example, is it a public sector organization? Is it a private, organization? Is it a limited company? Those kind of things is what we are going to look at, very quickly in the first part of the task. Okay, and then I think in terms of what I think I've provided you earlier. Do you recall this sheet?
Yes.
Yeah. So what we are looking at is for task 1.1, we're going to go through a couple of slides today, just to refresh some bits of the things that we've discussed earlier in task 4.1, I think, and to a certain extent, 4.2 as a unit. So let's look at that. Now, having looked at this particular slide in terms of the different types of businesses, can you classify what type of business is this, Walkers? It's a large private sector company, Walkers. They produce chips and crisps and a lot of other products. It's, I think, a part of the Unilever brand. So the company is Unilever, and it's a large public limited company, or private limited company. Sorry, rather.
Yeah.
Correct. The Manchester College up in Manchester, one of the largest FE colleges in Europe, 35,000 students. This is predominantly a public limited company, though it's run as a charity, I think. But keep in mind the ownership of this the firm is with the government. So obviously it is listed as a public sector business, or an FE college which is owned by the government. They get the funding from there, so that's why it's public limited. Comic Relief, what kind of a company in terms of ownership is this?
Charity.
Charity, correct. When we look at McDonald's again, this is, so a differentiation here would be, when we just look at Walkers as a brand, that is a strategic business unit or one of the divisions of the Unilever business. So it is a company on its own, but obviously at some point in time when it was maybe acquired by Unilever, it has become one of the brands or product lines within Unilever as a company. And here, when we look at McDonald's, McDonald's is a company, it's a private limited company, but the ownership of this company lies both with private, investors, but also with shareholders, right? So it is a company which is traded in the stock exchange. The shares of this company, are traded in the stock exchange. So it has ownership both in the private oblique public sector in terms of, large scale investments which the company or the company board does in order to kind of, prep up its capital in terms of interest funding, other kinds of funding which they look at investing their profits into. Now, when we look at the concept of business, very simple. Business is nothing but it's a type of an organization which basically provides any form of goods or services. So when we look at charity, it is also an organization, but why is it a charity? Is because it is registered as a setup or as an organization which basically does not make any profits from its activities. It provides a number of goods and services like the comic relief. But in this case, the idea of setting up this organization is to provide services in general for for the public, which cannot afford, or kind of bridge a gap between the need and demand. But because they do not make profit, they set up a Now, when we know that the business is looking at, every business which is set up has some objectives. So they provide some goods and services. So it's good to know what is the definition of goods and what is the definition of services. So when we look at goods are products. Essentially, that means if I go to the supermarket and if I buy, say, for example, a chocolate bar, or if I buy a pack of crisps, I pick up a newspaper from the news agent shop, I'm actually picking up a product which will give me some services at the end. So if I pick up a newspaper, I'm going to be reading through the news which is actually published in that paper. If I eat a chocolate bar, then it is a product or a good, but what the chocolate bar does is it basically, if I'm hungry or if I'm starving or if I'm craving for having chocolates, then I pick up a chocolate bar. It gives me that relaxing, feeling of that I'm having something, which is a chocolate, which is what my appetite or, kind of thing was demanding for. So when you look at goods and services, goods will always be produced by companies, depending on the ownership, but some stage these goods will get providing some fulfillment or some sort of a service to meet that objective. And services, sometimes you also classify as, services which are tangible and intangible. Sometimes you receive service, for example, wherein you do not end up receiving a product, but you end up receiving the service. So a clear example of this would be when you end up calling a call center. Suppose you have a problem with your broadband and it's not connecting, or your telephone line is not working, you call up from your mobile. Now what they do is if they set up an engineer who comes in and checks and then rectifies the fault, then in that case, physically somebody is coming in and providing some sort of a tangible service to make the line operational again. But if they're able to diagnose the problem and then give you a solution from the call center itself, or basically do a tele support, as we call it, the term would be tele support, then in that case, you're receiving a service which is basically through the virtual route, or it's a virtual service, but it still ends up, obviously solving the problem in terms of, making sure that the line is operational and, it's functional again. So lots of services are traditionally classified as services like we know of. The council provides a few, services. Fire rescue is one of the services. You go to a hairdresser, and obviously when you ask for a haircut, they are also providing you a particular service. Is that okay?
Yes.
Now, because we are looking at the different types of business and we are looking at the ownership, what we need to look at is very briefly discuss about what is the main objective of setting up a business. Why do you think people set up a business? And why do businesses then become large, or some of them remain small, some of them become large, and they also look at global operations. So here it is defined in the vision and mission when a business is created. So if a certain number of objectives, which would mean that I'm looking at being self-employed, it could be that I want to have something of my own. At some stage, you want to look at, when you do the planning of the business in terms of vision and mission, you would say, okay, I would like to start with one, but maybe in 3 to 5 years time, might want to have another restaurant in another location. And that would be all defined within the main objectives of your vision statement or your mission statement. Now, mission would be that you want to serve good food. You've had lots of food, you've done a lot of takeaways, and you've had lots of meals outside, but the reason why you want to start your own restaurant would be that you had so much food over the years, but you still can't get enough in terms of the taste that you want when you cook the food yourself. That kind of a service might not be available outside. So that would be one of the main underlying reasons of why you set up the restaurant, why you go out and set up your own restaurants, is because you feel you'll be able to provide that as a service, and that service would then at some day, at some point in time, be meaningful, and that meaningful service will basically allow you to get or earn profit. So basically every business goes through the cycle of setting some objectives, and these objectives in terms of short term will be defined in the mission statement of what is the ethos of the business, why it was set up, and in terms of a long term, you define it in terms of your vision. And at the end of the day, most businesses, when they are set up with some objectives of obviously making profits. That means at some stage you would want to break even, and when you break even, that means you've recovered the money that you spent in setting up. You then want to basically look at making profits. You want to make money. The business wants to make money, and you want to make money. And because you provide a certain amount of service, you expect in return, services, your payment for those services. And as long as you are able to maintain a quality of your service, people keep coming back to you again and again for having another meal and things like that, and that's how your business begins to grow. So objectives this is for a small business, but when you look at, say for example, when Jack Owens set up Tesco a number of years back, or in the early 1920s, 1940s, he did not envisage that the business will become this big and it will work or operate in 12 to 14 different countries. But at some stage over the years, they have moved the goalpost. Every 2 years, 3 years, when there's a bit of a strategic planning done, they have planned out that, okay, because the business is doing well, they want to expand, and that the expansion would have been fueled from a point of view of changing vision within the company. And that is what you get to see sometimes also is linked to the change of ownership. So maybe it was a privately held business initially when it started, but over the years, as the business became profitable, the operations became large, number of employees increased. At some stage, the owner of the business could have brought in an external person or a consultant to see that how we can further scale this up, and that would have meant that they would have added more products and services. So we know that in the last few years, Tesco as a laggard, that means they were lagging behind with regards to other competitors to introduce something called a e-tailing or a e-retailing strategy, e-commerce things. So Tesco, I think in 2012, 2013, invested in the IT infrastructure, and they started to create the e-commerce side of the business, wherein you today can buy a Tesco mobile, you can buy electronics, electricals, and a lot of other gadgets and goods and services through the online route as well. So a modernization of this concept happened because, one, the competitors were moving ahead in the market, and the second is they saw this as an opportunity for the business to expand. And because now internet connectivity and availability of internet makes things easier for consumers to purchase, it meant that at some stage this should have been adopted as a business model. And because this has been done from a point of view of long-term perspective, this has meant that the company is now looking at expanding and selling some of these products which are non-perishable items, things. I'm not talking about grocery and other bits, food and grocery items, but electronic, electrical, services which they can sell across in different countries, having set up everything within the UK. So they might be able to sell this in Turkey and some of the other European markets where Tesco is present, but some of that operations could be managed from the UK or from Britain essentially, but these services are then delivered in other countries. Is that okay?
Yeah.
Now, some of these slides we'll go through quite quickly, because when you look at why do we call a business a public sector and why do we call a business a private sector business? Now, public sector business is defined as an organization which provides people with goods and services, but is financed and controlled by the government. So when we look at public sector, We think of the councils, we think of police, we think of fire service, we think of NHS, we think of schools, and anything which is in the public remit. That means it is not funded or financed by the people, but it is funded or run and owned by the government in that country. Is that okay?
Yeah.
Army, for example, would be a public sector business or a private sector business? The armed forces.
Armed forces, that would be public sector.
That is correct. So when we look at state ownership, in short, we call those businesses which have state ownership as public sector businesses. Businesses which are owned by private investors would then be classified. So when we talk about Virgin Trains, for example, that is a privately held business because Richard Branson owns the company, and obviously it's in the public domain, but there the public ownership is in the form of shares or investments in the form of bonds. But essentially the business is owned by the private sector because it has no direct funding or financing from the government to run its operations. Is that difference clear enough?
Yeah.
Yeah. And when we talk about private sector organizations, within private sector organizations, we have different type of setups. So if it's a single owner-driven organization, then we will probably call it sole trader. If it's a number of partners which come together and form a business, then we will probably call it partnership. An example here would be of accounting firms, solicitor firms, wherein you see people who do the same function, same type of job, actually come together to broaden the business or enlarge the business. So you could have public sector private sector companies, and you can also have charities. Charities essentially do not get any funding. The setup of the charities, which is another word, would be non-government organization, NGO, or non-for-profit. They are essentially private businesses, but they are set up to provide services to the public free of cost. In some case, when I take an example of Oxfam, you will see that Oxfam essentially gets a lot of funding from the government, but it's a charity and it is a business which is run privately without intervention from the without any direct intervention from the government. And that is why I would kind of say that the ownership of the business in terms of the management, the structure, and the employees and the assets of the organization are not in the direct control of the government, or are not directly financed by the government. So that is why we look at this as a private sector or non-government organization, not for profit, but NGO, non-government organization. Is that okay?
Yeah.
Now, there is something that we add sometimes to businesses. We say public sector organization, private sector organization, but when we go beyond that and take it to the next level, we talk about private limited company. Public sector, but a limited company or a limited liability company. Now, what are the reasons why this is called? So, when you form a company, sometimes what happens is, not sometimes, when you form a company, you will also be required to form something called Memorandum of Understanding or Memorandums of Article. That means there is some agreement which exists between the partners, directors of the company, and they are going to abide and agree to that particular memorandum of articles which have been set up. Sometimes you have just an understanding. That means if this is to happen, then there is no liability, at least on the directors, but the liability is only related to the company. So sometimes you get to see in organizations, when they form up a company, what they will do is they will form something which is called a limited liability company. Here, the limited liability means that at some stage, if the business is to go bankrupt, or is the business is going to go, say, belly up, then in that case, the directors of the company are not liable to, for example, bridge the losses, or not liable to be indicted if the company ends up making a loss. Is that okay?
Yeah.
So look at limited liability. That means the business, if it goes into administration, then in that case, the money which has been invested in the company in terms of assets or in terms of liquid money available in the bank is the only bit of money which the business will have liability of. But if it's a limited company, then in the case, to a certain extent, if the business is to go belly up or bankrupt, then in that case, the assets which are owned by the director of that company could also be used to pay for the debts of that organization. Is that understood?
Yeah.
Yeah. In most cases, what they tend to do is they do not tend to look at, setting up companies when it's a small business. You have to keep in mind that if you set up a company, you have to keep it in mind from a point of view of understanding what is unlimited liability and what is limited liability. So if it's a private limited company, that means it has unlimited liability, and at some stage the owners can be indicted for the debt or the losses which have been created in the business. But in a limited liability company, the owner of the business is separate in terms of the possessions and the assets that he has or she has is separate from the assets, and there's a bit of differentiation between the business and the owner director of the company. Okay?
Okay.
Now, just looking at very briefly a few slides to understand what is a sole trader. So when you look at there being one owner in the business, and that owner is also the director of the business, and could be a private or could be a private, it is a private limited, but it could be private limited or private LLC, limited liability company, the way it's been set up. Here, the source of fund in terms of the business is usually coming in from the owner or the owner's saving, or the director and the director's saving. And in some cases, the advantages of having a business set up as a sole trader is that you will see things like decision-making powers are, decision-making is simple. Because a small business, the one man or the person who's working within the business is also the owner and also the worker himself. And sometimes it's easier for them to take decisions to turn the business around, move the business to a particular direction. And here the examples would be, you look at newsagent shops, you look at plumbers, electricians, people who are self-employed essentially, but have set up as a entity, which is wherein they are the owner and director of the business, would be termed as something called a sole trader. Is that okay?
Yeah.
Now, when we look at partnership, when two or more people own the same business. So, for example, when you look at an accountancy firm, as the business begins to grow, what tends to happen is, as your clients increase, the number of books that you manage increase. What those kind of businesses tend to do is they kind of expand into partnerships. So what they say is, if I have to come together with you and you're also an accountant, I'm also an accountant, because they have the same profession, sometimes it's easier to have the people working within the business with similar backgrounds to come in and help you out to expand the business. So when you look at PricewaterhouseCoopers, this was an accounting firm, and PricewaterhouseCoopers, who at some point in time came together, and as the business expanded, they started to take into account different clients. So, for example, this, hypothetically speaking, I don't know the history myself in that much detail, but why they came together and the company merged, and it formed finally and came to be known as PwC, is because Price and Waterhouse were focused on a particular segment, enterprise segment, in terms of maintaining and doing accounts and audits. And Coopers was a firm which was dealing with small and medium businesses, maintaining books and accounts, taxation and other issues. So when they looked at expanding business, what they did was they came together as partners, and that is how PricewaterhouseCoopers came across. So this kind of a thing that we get to see when you have more than two people as owners of the business. Generally, you see people coming across from the same profession. They want to be jointly responsible. That means they do not want to relinquish their responsibility, but they want equal ownership and equal responsibility within the business. At some stage, what you do get to see is that when you firm up a business as a partnership, again, this falls within the remit of being limited liability company. That means the liability remains with the firm rather than the liability transferring over to the directors or the partners within the company. And at some stage, because it's a partnership, if the company is to make profits and the dividends have to be given out, they are given out in equal percentage, depending on the memorandum of articles or understanding which is being created at the beginning. If I say, for example, you and me get into a business and we become partners, if we are 50-50% partners, are we 60-40 partners, are we 40-60, are we 70-30, that defines what kind of ownership you would have in the business. And also what kind of dividends or profits you will be able to derive at the end of the year from that particular partnership business. So these kind of businesses normally, or formation of companies normally seen within professional services. You look at solicitors, accountants, you will look at plumbers, for example, they will, or any such services business wherein more than two people come together to firm up something in order for the business to grow, or because they provide the same kind of services or they have the same kind of background profession, is why they come together and decide to scale up operations. Is that okay?
Yeah.
Private limited companies, business which is owned by shareholders. That means at some stage, if the business operations have gone big, and the business operations, when they've gone big and the company has actually issued shares, or there are shareholders of the business. So if you look at a taxi company like Hart Taxis, or if you look at a business like, for example, any such small business, when you look at, say, let's look at an example of let's look at Wagamama, for example, or you look at any such restauranting business which primarily is in different locations. So what at some stage they do is, rather than have the company open a lot of other franchise, outlets in other locations, they kind of franchise the business model. And in that case, what they do is they ask you to set up an outlet in a different location wherein the branding, the products and services, they're all kind of uniform. But at some stage, what they want to be able to do is, the family or the people who started the business want the business to grow, and they relinquish some part of that control in the business and then give it into something called private ownership through the shareholding, and that is where then the business begins to grow. So this is normally you will see in small to medium-sized businesses which were traditionally family-run businesses, or businesses which primarily started off as small, but over a point in time, what has happened is that these businesses, when they look at expanding, what they want to do is basically come under the umbrella of something called private limited companies. And here you could have more than two owners minimum, because there are shareholders. Here, some of the shareholders could also be directors, and some of them could be sleeping directors. That means they do not play an active role in the operations of the company, but are still considered shareholders. And because they are shareholding, they have invested into the company and own some shares of the company. They are classed as directors. But the ownership in general here is within private hands. It is again got no funding or no financing coming in from the government, and that is why they are private businesses. An example when I say an example of a taxi company, or say for example a restauranting food chain, the advantages of setting up something and looking at this would be to look at expansion of the business at some stage, also to ensure that you are not entirely held by large organizations which basically buy a stake in the company and then take away the ownership from you. So here the advantage is that you're setting up something as a private limited company wherein you can have a shareholding, you can have other people come in and invest into the company, but the ownership of the company still remains within the hands of the the original people who started this as a business or as a concern. Okay. Now here, the key difference is, in terms of private limited company and public limited company, the key difference between the two is that private limited companies, you create shareholding, but these shares are not publicly traded in the market. Okay. If it is to become a public limited company, it could still have private ownership, but in that case, because it's listed on the stock exchange, that would mean that the members of the public own shareholding into the company, which makes them shareholders. That means it makes them stakeholders of the company, but they still do not have decision-making powers to influence the day-to-day operations of the company. In the recent news, for example, you've seen ICANN, which is one of the largest property management funds. I don't know whether you've seen this or heard about this name. ICANN, ICHAN. This particular private fund Basically, he's a global investor, and he has up to 4% shares in Apple, for example. And if the shareholding increases any more, then he has to be offered a directorship position at the Apple board, right? You see, when some companies, some investors, which obviously buy a lot of shares within the company, the reason why they buy shares in the company is that they want to become, what do they want to become? Shareholders,
Yeah.
stakeholders. Yeah. So they want to become stakeholders or shareholders essentially in the company, isn't it?
Yeah.
Right. When we look at that, if I can get the. When you look at that in terms of somebody, biggest private shareholder of Apple. One second. So here, when we look at some of the biggest shareholders in Apple, what we do get to see is that there are some large consortiums or companies which basically own a lot of shares within the company. But at any given point in time, Carl Icahn, the person I was trying to refer to, basically is a investor in the companies. But the reason why he invests in the companies is that he wants to influence the direction, influence the decision-making power, and which the board has in some terms within certain set of companies. He knows that the company is profitable, but at some stage he was asking Apple to diversify because 75% of the revenues of Apple as a company today are coming from the product. What kind of product?
iPhone 8.
iPhone 8, yeah, or iPhone in general. So iPhone is the biggest revenue earner for Apple at this moment, and what he's forcing by buying more and more shares at any given point in time in Apple is that he wants to take a position in the board, and when he gets a position on the board, he is in a position to influence decision making happening within the organization. So when you look at public sector company and you look at private limited company or public limited companies, the difference is that in those cases, the shares of the company can also be held by people outside the initial remit of the organization, but they do not have voting rights or excessive voting rights until you have lots of shares for you to be able to influence decision making. So private limited companies we do get to see in small businesses, small to medium businesses, and the ownership here is done in that way. The setup is done in that way so that it is able to, the initial owners are able to grow the business. Okay. When we look at public limited companies, we look at larger businesses which are owned by shareholders, which I was coming to. So, for example, BP, McDonald's, for example, Apple. When you look at, they are large companies which are in the public sector domain, public limited companies in the public domain, because a lot of shares of these companies, because they are traded on the stock exchange, and the shares are then owned by general public or people in general, and that's why they have they are classified as something called public limited companies or PLCs. So it is called Tesco PLC. So we say PLC is public limited company because the shares of the company are owned by shareholders, which at some stage means that they are stakeholders into the business. Okay. Now let's look at very briefly. So this activity sheet I'm going to send to you, which basically summarizes the ownership of the companies, and the other bit that we want to look at is essentially what are the key things which end up influencing the organization. And that is what we study in the aspect of, when a company goes global, that means it has operations in more than one geography or in more than one country. And because the company or the organization is actually having operations in more than one location, that means it needs to deal with law and legislation in different locations. It needs to look at, orienting its resources in a way wherein the operations of the company are productive in all locations it operates in. And some of the slides that I'm going to quickly go through will talk about, what are the influences of globalization on a particular business. Okay.
Okay.
So what do you mean by the term globalization? What do you mean by global?
All around the world.
Right. Okay. And
Worldwide.
so when we look at, say for example, something to do with, say let's take an example of Tesco. So this Tesco's business, Tesco is Tesco PLC. It's a public limited company. Its operations are in more than one geography. So we classify this as an organization which is a public limited company, but also has operations across the globe. That means it is present in more than one location, right? So what is the process? Why do we the reason when we say Tesco's business is global is because the company has businesses now in different locations, and the business can or has influence or is influenced by, let's put it this way, the economic environments of different countries or different geographies it operates in. So when we say globalization means that you are looking at running your business as an interconnected business or as a business which runs across different countries, but also has external, influences because of legislation of that country, because of restrictions on, say, for example, the movement of goods, the import and export tariffs and things like that. The exchange rate in terms of fluctuation in the exchange rate means you could have bearing on the pricing of the products in that country when you sell. And in general, you also look at dealing with the law and legislation when you employ labor, staff, resources, and other bits and pieces within that context. So globalization definitely as a factor has become something which affects all businesses now. And if you look at the post-World War II era, most businesses, most companies which started off after the post-World War II era, in the early 1960s, 70s, when they started mass producing goods and services, they started to export some of these goods and services abroad. And because of which they had to set up the operations in other countries. And here, the aspect of the business, which was a national business or in one particular geography or location, actually became something what then it came across to be, known as something called a global business. So you are no longer just producing from one location and shipping it to the other, but at some stage they started operations of manufacturing, production, procurement, supply in different countries as well, and that is why the operations then truly became something called global. Correct?
Yeah.
Example of coffee plantations. Tesco has their own brand of coffee, Barista. You look at Costa, you look at Cafe Nero, you look at Starbucks. They all produce coffee and serve coffee. But they're in terms of procurement of the business, they buy coffee beans from China, from Egypt, from Africa, from Costa Rica, different countries in the world. But because the processing of some part of their, finished product happens in that country, they have to have operations there locally to be able to, comply with the law and legislation of working within the geography, but at the same time provides them a global remit in terms of working within the business. And that would mean, brings me to the next slide, is when we look at recession or when we look at, boom, that means the economy is growing of a particular geography, the economy is growing, the conditions are viable, so the business is flourishing. But in some cases, when we had recession or when the demand and supply is contracting, normally see that they tend to reduce the supply so that they have only those products available for them to be able to service the market for a certain amount of time. And in that case, what we do see is the business then contracts. So in some cases, what they tend to do is, and in that case, they look at cross compensation of business or profits essentially across different countries. So Tesco as a business in the UK is making profit. But if you see, Tesco has now closed down operations in the US. I think about a year, 2 years back, they decided to pull back operations in the US. The reason why they folded the operations in the US is that from the day it was launched, the business has not made profits. And it was not viable for Tesco to be able to then, have an operation running in the US, which was cross-subsidized by the operations in other countries from a point of view of profitability. So the board actually then took a decision a couple of years back, and they decided that we're going to pull out from that market. And it has got nothing to do with recession or, but it found the competition in that market to be very tough. And because it did not make profits over a number of years, they gave, the board itself gave the America operations about 10 years for it to turn into profitable business. But because it did not happen in the 10 years, they did a very strong, analysis of where and why they are going wrong, and decided to pull out because of the fact that here the globalization from a perspective of expanding into the largest market in the world did not make sense for Tesco, because the market was overcrowded. There were other large stores like Seven, Costco, Walmart, lots of others, JCPenney, and they found the operations in that country becoming tougher by the day because of localization, which was present within the businesses, and the supply relationship which was present within the businesses for others, as against what Tesco did not have. Okay.
That's it.
So, in terms of when we look at when we look at, say, for example, economical factors. Now, there are lots of economical factors which also affect the business. Now, it could be to do with things like contraction in demand. That means, if a particular operation in a particular country is not experiencing increase in their products and services, but on the other hand is actually contracting, that means it's decreasing, the demand for those products is decreasing, you will see that there's a contraction which happens as far as that business is concerned. So sometimes we get to hear this term that which we get to hear is the fact that we talk about that the economy is contracting. The GDP of the country is contracting. That means the demand is shrinking, and because of which the overall economy of the country is shrinking. So external factors affect the business when you are working within the global environment. How do they affect, and what kind of effects they have, is something that we will look at in Learning Outcome 2 when we study it next week. Is that okay?
Yeah.
So I'm going to stop here today and obviously send you a copy of this presentation and a handout for you to read, which will help you crystallize some of the tasks that we are looking at, understanding of why companies look at business operations and expand on a basis wherein they want to go global, and at some stage what are the benefits and advantages of the companies having operations in different geographies. It is influenced by ownership structures, the way the businesses are set up, the different type of sectors they operate in, and to a certain extent at some stage follow the law and legislation in different locations and geographies.
Okay.
Brilliant. Good stuff. Thanks for joining the session today, Phil. And the other bit is any questions and queries. As always, I would suggest that you email. And there is a book that I'm also going to email and upload on Moodle, which will have the coverage of the entire content of this unit. And this is one of the recommended books that you will see, which we will kind of upload, so that at some stage, in order for you to crystallize what we're discussing and get some more depth into the topics that we are covering, you'll be able to read through some of the chapters. Now, the book is an extensive book because it covers, globalization as topic, business organizations as a topic from level 4 to level 7. But my suggestion would be, I'll send you emails which have some, specific pages for you to be able to read through, and that those will directly help you in also doing your assignment.
Okay.
Okay. Brilliant. You have a good week.